So the stock market is selling off, and it's happening for 5 main reasons. The first reason is a key trend finally broke. So for months, the stock market moved up almost in a straight line. The S&P 500 stayed above its 50-day average, which is the market's normal temperature line, for 138 days, which is extremely rare. Once the index slipped below that line this week, trading programs that automatically buy on the way up and sell on the way down switched direction. There was extra selling pressure because a lot of people just trade on trends rather than fundamentals. The second reason is that the rally was being carried by the tech companies. Almost all of the year's gains came from big AI names like Apple, Nvidia, Meta, and Alphabet. And when the market depends on a handful of companies, that makes the market a weak thing. So Meta is down almost 25% from August. Amazon just borrowed $15 billion, a sign that AI expansion is expensive and requires huge debt. The market has also been less willing to lend debt to the AI companies. Then you have Nvidia, which is the stock that became the entire symbol of the AI boom. They report earnings this week, and for the first time all year, investors are not assuming that the results will save the market. People want evidence that all of the AI spending is turning into real revenue. The third reason is crypto. So Bitcoin fell below 92,000 and it erased all of its gains for the year. Traders are buying protection in case it drops even more, which is a sign of real anxiety in the crypto market. And it comes on the back of the big banks allowing Bitcoin and Ethereum for collateral for loans, something that might seem pretty risky now. The fourth reason is the job market warning signs are flashing. So companies are required to file early warning notices before mass layoffs, and those notices just surged to one of the highest levels since before 2008. We're going to get some government data on it this week, so hopefully it tells a better picture than that. The final reason is private credit showing cracks that make investors uneasy. So private credit, again, is when investment firms make loans rather than banks. The market has grown to almost $2 trillion and it's marked as pretty safe, but there are all these cracks starting to show, like I've talked about in other videos. Many of the loans are to financially weak companies. The loans aren't traded publicly, so valuing them is a form of guesswork. So we're starting to see actual cracks. BlackRock, after JP Morgan just lost $175 million on a private credit situation, has marked some of their loans to worthless, and several companies tied to private credit have defaulted. So the final bonus reason is the Federal Reserve. It seemed like it would be a sure shot rate cut in December. But some Fed officials are saying, hey, no, we're actually probably not going to cut rates in December. The data delays from the shutdown have made the Fed a lot more hesitant. Investors don't know which way the Federal Reserve is going to go, and markets hate uncertainty, which is also part of the sell-off. So it's a lot of things kind of compiling into one. The market is supposed to be an arbiter of truth. It's not supposed to go up all of the time. And right now it is conveying the truth that things are very uncertain.